Meeting to order, and pursuant to Standing Order 1082, study of the report of the Bank of Canada on monetary policy, and as witnesses in the first hour and a half, we have Mr. Pelosi, who's the Governor, and Ms. Wilkins, Senior Deputy Governor. Welcome, Governor and Deputy Governor. The floor is yours. We'll start with an opening statement and then go to questions. And again, welcome.
Thank you very much, Chair. My apologies for a couple of minutes of tardiness, as we're not quite used to the new arrangements. It's our first visit to the new building.
Us too, when we've been here for a few weeks. So.
Well, good morning, everyone. Once again, Senior Deputy Governor Wilkins and I are pleased to be with you to talk about the bank's monetary policy report, which we published last week. Lors de notre dernier témoignage, il y a 6 mois, on estimait
6 months ago, when we last appeared before the committee, we talked about some very positive developments. The Canadian economy had solid momentum and had essentially completed its journey home. That is to say, it was operating very close to its capacity, and inflation was running near our target. At the same time, we were monitoring the risks posed by protectionist trade measures and elevated levels of household debt. Unfortunately, since then, there have been a couple of negative developments. These have caused a detour for the economy, and they are delaying its return home. Our forecast is based on the belief that the impact of these developments will be temporary, and that once the associated adjustments take place, stronger economic growth will resume. So in the MPR, we marked down our forecast for economic growth this year to 1.2%. And we project growth of near 2% for both 2020 and 2021.
First, the global economy slowed toward the end of last year. To be clear, some slowing was expected as the stimulative impact of U.S. fiscal measures fades. But the slowdown was deeper than most forecasters projected and has persisted into 2019. A major factor behind this global slowdown has been the U.S.-led trade war. This is delaying business investment decisions in many countries around the world. Uncertainty about future trade policies has risen. Here in Canada, doubts about the ratification of CUSMA have increased, and these remain a downside risk to our outlook for investment. It is certain that an escalation of trade conflicts would be a blow to the global economy. However, the global economy could receive a significant lift if there were progress in resolving these conflicts. I should emphasize that businesses and economies will ultimately adjust to the heightened level of uncertainty around trade by adjusting their investment plans lower. But once those adjustments are complete, however, economic growth can pick up again. The other major development since October was another sharp decline in oil prices late in 2018, which put Canada's oil sector under considerable stress. More recently, oil prices have firmed, including the prices of our Western producers receive. But transportation constraints on future growth remain a significant source of drag and uncertainty. This has led to another downward revision to investment intentions in the sector. Some of this downgrade is likely more structural than cyclical in nature, as it represents the continued adjustment of the sector to global oil prices of $50 to $60 per barrel, rather than the much higher prices of 5 years ago. This adjustment process is also being reflected in wages and other costs, and developments in the housing market in Alberta. It's important to note that as investments in the oil patch are pared back, Canada's growth slows. But when those investment levels stop falling, Canada's growth will pick up again, even if oil sector investment does not, because other areas of growth will come to dominate the data. We saw exactly the same dynamic following the oil price shock of 2014-15. In addition to concerns about global trade and oil prices, we've continued to watch how the Canadian housing market is adjusting to a combination of factors: provincial and municipal housing policy measures, the revised guidelines for mortgage lending, and past increases in interest rates. The adjustment of the housing market is particularly important given the context of elevated levels of household debt. Our analysis has been complicated by activity in some previously frothy markets, the Greater Toronto and Vancouver areas in particular. Research by bank staff shows that the sharp rise in housing resales above fundamental levels in Ontario and British Columbia, and then the subsequent fall, correlates strongly with house price expectations. This suggests that provincial and municipal housing policy measures have had a much stronger impact on housing activity than changes to mortgage lending guidelines and past increases in interest rates. Cette analyse est renforcée par le fait que l'activité
Supporting this analysis is the fact that many other markets across the country are seeing solid activity, even though they have the same mortgage lending guidelines and interest rates. This is what would be expected in an economy that is growing with a rising population and strong labor market. The implication is that as the situation in Toronto and Vancouver stabilizes, the Canadian housing sector should return to growth overall later this year.
The federal government and several provinces have made fiscal announcements during budget season. Our analysis suggests that the combined impact of adjusted spending plans announced to date would lead to a downward revision for our growth outlook of about 0.2 percentage points in 2020. In sum, the Canadian economy is currently facing some headwinds, but there's good reason to believe that the economy will accelerate in the second half of this year. In this context, the bank's governing council judges that an accommodative policy interest rate continues to be warranted. We will continue to evaluate the appropriate degree of monetary policy accommodation as new data arrive. In particular, we are monitoring developments in household spending, oil markets, and global trade policy to gauge the extent to which the factors weighing on growth and the inflation outlook are dissipating. And finally, in case you've not heard, I should mention that since we last met, we launched the new $10 banknote featuring Viola Desmond in the Canadian Museum of Human Rights in Winnipeg, and it has been named the best new banknote in the world for 2018. With that, Senior Deputy Governor Wilkins and I would be happy to take your questions.
Thank you very much, Governor, and we always appreciate when you come before committee and the work that both you, Deputy Governor, and the Bank of Canada does. So we'll start 7-minute rounds. Mr. Sabara.
Thank you, Mr. Chair. Welcome, Senior Deputy Governor and Governor. In the last 3 months, we've had a series of reports come out. Data report. We had the Business Outlook Survey. We had the Monetary Policy Report. This morning we had February GDP, international trade in the last couple of weeks. And the one measure that we brought in the fall economic statement, and it's in the BIA, is the Accelerated Capital Cost Allowance, which has been referred to in both the Business Outlook Survey and the Monetary Policy Report. And it seems to me that firms are responding to that measure. Would you care to comment with regards to the immediate expensing and what that should do to firms' investments intention?
Well, it's at this time I think it's still difficult to say. Certainly, you're right that the surveys, our own survey in particular, companies are mentioning that. They were mentioning that as a possibility back in our previous survey. And it comes in the context in which expectations for future investment were actually pretty strong, but as we've noted, companies have been holding back their investments because of uncertainty around the future of NAFTA. That uncertainty was lifted for a time late last year once the CUSMA was signed, but it seems to have reemerged again in light of the difficulties around ratification. So that's important context. I would think that all other things equal, expect to see a response to this tax change, but we haven't any data on investment yet for 2019. Our first data will be in about 4 weeks' time. At the end of May, we'll get the first quarter data on actual investment spending. So before that time, I'd have to wait and see what the data say.
And secondly, StatsCan reported at the end of February on the poverty levels in Canada and how poverty levels had, and this deals with fiscal policy more so than monetary policy, how poverty levels in Canada have declined considerably since we've come into government, in part owing to, I would say, the Canada Child Benefit, which the Bank of Canada has measured its impact on households and household spending. I wanted to see where the bank feels, with a decline in poverty across over 800,000 Canadians have been lifted out of poverty, how powerful an instrument the Canada Child Benefit has been for Canadian household spending.
Well, I would just say that back when we were analyzing the macro economy, back when it was introduced, it made a significant difference to the level of the macro economy. And as for comments related to poverty and distribution of income, I'll turn to Ms. Wilkins.
Clearly, the Bank of Canada doesn't have any control over the distribution of income. We deal with the inflation rate, but at the same time, distributional aspects of the economy, so the distribution of income, distribution of wealth, distribution of debt, actually can have a big impact on how the economy performs. And so we pay close attention to labor income growth, which is a big part of people's well-being. And we see that wages are growing across the country, less in areas that are affected by oil, actually quite a bit less, and that's to be expected. With wage growth overall about a little over 2%, it's still a little bit shy of where we would expect wage growth to be relative to productivity and inflation, but certainly we expect that to pick up. Getting back to the distributional implications, one of the things you can look at is how is labor income share in GDP? What's the share of the pie that labor's actually getting? And I just happened to look at those numbers and can see that over the last, since 2005, so you kind of go predate the crisis, labor share in income has actually increased. It's nudged up a little bit. It's certainly down from where it was, say, in the 80s, but it has edged up.
Okay, thank you. One of the things in the monetary policy report that came out to me were the cuts that would have been introduced from the provincial government in Ontario. In terms of the fiscal impact on the economy, and you've modeled it, and it's come out to be not directly, but 0.2% to 2020 growth. So I want to put that on the record that a provincial Conservative government in Ontario and their fiscal policy will impact the economy, the Canadian economy, negatively in 2020. Any comments, Governor?
Well, no comments beyond the ones I think you've offered. For us, it's basically mechanics. It's not a judgment about how policies will perform or how the mix of policy may have changed things.
30 seconds? Okay.
And so for us, it's just a matter of taking the spending lines that are laid out in that budget and compare them to the spending lines that were in the previous budget. And in 2020, there is this difference, and it subtracts relative to where our forecast was. Yeah. It doesn't drag the economy per se, but it reduces where our forecast goes.
Thank you for that color, because we've seen obviously that teachers are being made surplus in many ridings across across the province of Ontario. That there have been layoffs. That everything from a $4.7 million tree planting program is being cut to inspections and so forth. So the details have come out. Public health funding in the City of Toronto is being cut. So it's sad to see that the province is adopting that measure. That's my personal opinion. Going back to monetary policy, though, you have revised down the neutral rate by 25 basis points, and we're at 1.75. So we can do the math. It would require 2 more rate increases to get to the lower bound of the neutral rate. Global growth the changing global growth has impacted us, but Brent prices today are up at $73. I don't know where the discount is, but I'm sure WCS has gone up a little bit as well. Is the neutral rate revised down because of transitory factors, or was it revised down, in your humble opinion, because of permanent factors?
I would say that revision down is primarily structural. I wouldn't quite use the word permanent, but that revision reflects 4 separate methodologies, which look at it through different lenses. And the main thing that's going on there is that the global neutral rate appears to be have drifted lower, and it's done so for the last couple of years. that happens in the context of important drivers such as slowing labor force growth. That's because those of us who were, baby boomers are gradually retiring, and that big bulge in labor force participation is a 50-year period during which we had much stronger growth in labor force globally, not just here. And that's coming down to what you might consider to be historically more normal, if you just think of the 50 years as abnormal. And so that is the primary driver, and that's just, again, it's close to mechanics. It's not a very sophisticated analysis. It's just that you can't have much. The economic growth trend line for the world is driven by that labor force and by productivity. So it's only if we did have a long-lasting rise in productivity would there be pressure for it to rise up, which is why I wouldn't say permanent, because that, of course, is quite possible.
Okay.
Thank you, Chair.
Thank you all. Mr. Kamish, around 7 minutes.
Thank you, Mr. Chair. Governor, on November 23rd, 2018, on a Friday, the Bank of Canada put out a notice: expansion of assets the Bank of Canada will acquire for balance sheet management purposes. Specifically, it was informing, I guess, the markets that you would start buying Canada mortgage bonds. Why did you take that step?
Just to interrupt for a sec, the bells are ringing. I'm assuming we got unanimous consent to continue till about 7 minutes to or so. We okay? Okay. All right. Go ahead. Sorry, Governor. There's a vote in 30 minutes, but we'll go till about 7 minutes before we had a vote, or 5. Go ahead.
Yes, that was a decision that was entirely related to how best to manage our balance sheet in a way that doesn't impede the performance of a major core funding market, which is the Government of Canada market. Because of the size of the debt outstanding, and that's either Treasury bills or government bonds that are issued, and the needs of our balance sheet, we were taking up more and more of the bonds in the primary market. And because of that, we're not leaving enough for the private sector who actually need those bonds. And so in our balance sheet management, we look at, well, what other obligations which don't put the Bank of Canada's balance sheet at risk are suitable for balance sheet purposes. That was one asset that we had considered a while ago and decided to start purchasing. And it has nothing to do with anything other than that, including it doesn't have anything to do with the state of the housing market.
Can I ask you then, because it says here it's on the primary market on a non-competitive basis, but it sounds like you are actually going out and buying Canada mortgage bonds. According to your balance sheet, as of March 31st, 2019, you have about $500 million of them showing on your under investments. So are you competing with the private sector on the market then to buy these bonds, or are these bonds that others don't want to buy?
We buy them. Others would want to buy them, but we buy them in the same context that they do. I can get back to you on the exact format of the purchasing arrangement.
Please, yeah,
but
that would be
I can do that.
Very helpful.
Yeah.
Could we also get a breakdown? Like, do you know when you're purchasing them, are they coming from regulated lenders like the chartered banks, or if they're coming from?
I will get you all that information. I can just tell you that our principles for anything that we purchase are heavily focused on mitigating any risk that we might have on our own balance sheet, and also mitigating any impact we may have on the market. So market neutrality is a very important principle that we follow.
So how do you do that? Because there's like a bidding system involved here. So
Sure.
if you're not competing, it's on a non-competitive basis. So
for
so people
Government of
don't
Canada
know you're the
bonds,
ones buying it. You do
Sure.
it through an
So
agent.
I can tell you for the Government of Canada bonds, we take up part of the auction, and exactly what I was trying to say earlier when I talked about, that you can take up a certain share of an auction, or a certain share of what's being actually offered before you start affecting the price. Once you get to too much of that as a share, then you start affecting the price. So we try to take that into account. I think it's impossible for us to not have any impact on the market. but we try to mitigate it. With respect to our actual
Sorry,
plans,
I'm going to
I think
interrupt you because I only have 7 minutes. On these Canada mortgage bonds,
Sorry.
These are Canadian mortgage bonds. This is the product that you're going to the market. What's your upper limit? Because you said it would be a small portion of your balance sheet. So what's your upper limit? What is small for the Bank of Canada?
That's a really good question that I don't actually have a number in my head, but it would be a much smaller proportion than the Government of Canada's that we purchase. That, of course, would change over time because, again, the reality is the government, what they issue, their debt issuance, is dependent on their funding needs for any particular year. So when the funding needs are bigger, it's easier to take a bigger share of that Government of Canada market. When they're smaller, which they have been in other years, then we have to adjust. So that proportion would change over time, but we certainly have guardrails around that, and I can get those to you.
Okay, so this will be like a percentage of total share. Yes. You have that number somewhere at the Bank of Canada.
We would have guidelines around that in our balance sheet management process.
So this isn't a form of quantitative easing, right? If you
Absolutely
weren't buying
not.
Canada mortgage bonds, you'd be buying Treasury bills, you'd be buying something else.
It's absolutely not. It is entirely for balance sheet management purposes, and it's not even close to a form of quantitative easing.
And so you're not adding on to the monetary supply M3?
Absolutely not.
No, sir. Okay. I guess I have another question. Because this was put out in November, and by the end of December, you had already purchased them. So how long were you considering to do this before you put out a notice ahead of time? Like, I'm guessing you did some analysis internally?
Yeah, we did some analysis. We've been doing this analysis off and on for a number of years in anticipation of knowing that we would have to take up too much of the market. We also considered other instruments. So that analysis would have been done and approved by Governing Council well before it was actually implemented.
How much time do I have, Mr. Chair?
Minute or 2 minutes, pretty near 2.
So you said you're very careful to ensure that you don't affect the market and the price that is obtained at the end, not to move the price.
We have a minimal effect.
Minimal
yes.
effect.
Yeah.
So when you're purchasing them, people don't know that you're doing it. So do you purchase them through an agent that you
I have
hired
to get
do
you,
this?
I apologize, I don't have all those details, and I'd hate to give you what I have in my head and have it not be entirely correct. So I would prefer to send you all that. We have all that information on our purchase policies, which may in fact be on our website, although I'm not entirely sure
I've checked.
if that amount of detail. Okay, so it's not there. We have them, and
Okay.
it's I'm perfectly fine sharing with them as soon as I can send them to you.
Could you share them through the clerk of the committee? And when do you think
Sure.
could we have these?
I don't see why we wouldn't be able to have something the end of the day tomorrow.
In writing, right?
Pardon me?
In writing through the clerk.
For sure.
Okay.
Yes.
Sure.
Great. Thank you. Well, those were the main questions I was going to ask you. And will you also be able to share that some of that internal analysis that you did ahead of time on why this would be the best course of action?
I can see absolutely. It's I think what I'd need to do is just check to see what kind of third-party information might be there that we would have to extract, if any. I just have to ask the staff to have a look at that. But
Okay.
Okay, thank you. We look forward to receiving that information. Mr. Dussault.
Merci, Monsieur le Président. Merci à vous.
Thank you, Chair, and thank you to our witnesses for being with us today. It's a recurring theme that's going to be my question today. I deal with it often when you appear here, and it deals with household indebtedness. Do you have anything new to say about the situation about household indebtedness in Canada? Is it improving? There are some studies that show that there are some good debts, for example, mortgages, and perhaps the recent polls also have indicated that 50% of Canadians are $200 away from bankruptcy. So they're very close to their limit each month. What effect does this have on the Canadian economy? What do you think about this? What can you tell us? The level of household debt in Canada is a high risk for Canada with respect to the financial system. And we've talked about this for a very long time now. We have noted that over the past year, The debt to available disposable income ratio has stabilized, perhaps, with respect to the prices. Here I'm thinking about mortgage rates and so on that have stabilized somewhat. As to the polls, it is quite sure that there are people that live very close to the line on a monthly basis. But we have to look at this overall. We know that 30% of Canadians have no debts. And amongst those who do have debts, their debt servicing has increased, but nonetheless, it is a higher level than beforehand. However, it is still at a manageable level.
One factor we might look at is how behind people are with their payments, the rate of personal bankruptcies. For Canada as a whole, that figure doesn't seem to have increased. It's still at a low level. In Alberta and Saskatchewan, of course, it's been difficult. And those difficulties are very understandable given the adjustments that people have been making in those regions. So when you have to decide whether to increase the daily rate, you take into account the impact it might have? Yes, of course. We've discussed it here, but I believe that we know that the impact of any increase is higher than it was since people are more in debt. Household debt has increased. Mortgage rates have increased but are now going back down. Mortgage rates are 60 basis points lower than they were at the beginning of the year. I had other questions. The first is on the impact that interest rates might have on the federal debt and on the annual payments, which are 20 to 30 billion or so a year, the debt servicing cost. Is that assessed when you establish your daily rate? It's part of our net analysis of the impact interest rates have on the economy, because people have bonds and securities, and it has an impact on that. But there hasn't been any really significant change for some time now. And the recent change is not significant. But I think there will be some risk in yields. It'll raise long-term rates. We'll see a raise in long-term rates rather than short-term rates. But global rates suggest that we'll have a fairly flat yield curve for a while. So it may be a risk because interest payments will go up, but we don't project that, just a slight rise. My other question was on a figure. I don't know if you can answer, but in the Department of Finance's magazine, we see that a surplus of $3.1 billion is projected for the first 11 months of 18-19, whereas there was a projection of an $15 billion deficit. So is there any explanation for that change? It's quite surprising that in just 1 month the projection might change from a $3.1 billion surplus to a $15 billion deficit. I saw in the papers that there was something on the current budget. From our point of view, revenues are higher than projected. And that's another sign that the economy is doing well and that the market is working well because it's generating revenue. That's another set of figures of data that suggest that the economy is doing better. The headlines might look occasionally glum, but there's a difference between these data and the data on demand and the data on production. At this point, we have to reconcile all those data. Mr. Fergus.
Monsieur le gouverneur, Madame le gouverneur adjoint.
Thank you. Thank you for being here today. Every time you come back here, Governor and Deputy Governor, I take the opportunity to ask you questions, just like Mr. Dussault, about Canadians' debt. This is certainly an issue that comes up whenever I knock on doors in my riding. You're certainly explaining with great clarity the relationship between debt and its impact on the economy or Canada's financial system. Are you optimistic about debt becoming stabilized, household debt in Canada becoming more stable, or are we in a position where we should be taking precautions? I will let you answer. As you said, that's the perennial question, isn't it? Since last year, we have seen some encouraging developments. First of all, the new rules on mortgages have made a difference, a positive difference. Second, the reasons for which household debt had been increasingly rising was the constant rise in housing costs, house prices. Those housing prices are no longer going up as quickly, and that was one of the greatest drivers of household debt. We're also seeing that the growth rate of the debt generally is less than the growth in GDP and the increase in revenue. So we're probably, well, I think we're probably past the peak, and we're now going to see over a number of years, over 10 to 20 years, there'll be an adjustment taking place, and household debt will go down gradually. It is, of course, looking better than it did 2 years ago. So let's talk about mortgages and the measures announced in the 2019 budget to assist first-time home buyers and the CMHC provisions. Are you taking a positive view of these, and what impact will they have on the Canadian economy? Our role is to assess economic impact. It's up to you to make the difficult decisions on policy. With regard to impact, it's still a bit early to say, and that's what we said on our monetary policy report. All the parameters aren't well established yet. In the fall, they will be, and by then we'll have a better idea. We will be taking a series of factors into account, factors that we already know, the parameters that provide a framework for the first-time home buyers program. And those parameters will help us to see how widespread the impact is. For example, a limit on mortgage levels as a ratio of income, a limit to the number of loans you can take out, 5% if it's not a new house, 10% if it is a new house. All these parameters tell us that there will most likely be an impact, that there will be a greater access to mortgages. That's the point of the program, in fact. But until we have all the figures in, well, we'll have a better idea in the fall. My last question is along the same lines of my question on the first-time homebuyers program.
Prévoyez que le nouveau
Do you believe that the new provisions to put a price on pollution will have an inflationary effect, even after the rebates that will be going back to Canadians? Or will there be a neutral effect, basically no impact on economic growth? With regard to inflation, we have calculated the direct impact, as we do with all policies that have an impact on inflation. That calculation required an assessment of the impact of the gas tax, the taxes on gas, heating oil, and natural gas. Inflation will increase by 0.1% in 2019, according to our calculations. In 2020 and the years that follow, there will be an increase of 0.05%. So there is an initial impact on inflation, and after that, it'll be very mild. Regarding the impact on economic growth, it's a complicated calculation.
C'est certainement possible que
There's certainly a possibility that there will be an impact on investment that are in sectors that are carbon intensive. So there is a potential, even likely, inflationary impact. But there will be more revenue, and at the same time, the country will be reducing its use of carbon. And there will be, as a result, less investment in carbon-heavy sectors. But then what do you do with the money you take in? It's going to encourage investment in other sectors. That's very difficult to gauge in advance. So I would say that it may have no overall impact, but we'll have to wait and see. Just like other issues that might affect the economy's potential.
les prévoit pas vraiment.
They are difficult to predict. It's a matter of looking at both sides of the question and all possibilities of any given situation. So there will probably be no real impact on the economy. First of all, because we are actually providing the money that's going to be paid out.
I have time when we come back for about 4 questions in a 5-minute round. we'll have to suspend Governor for, we'll probably be back in about 15 minutes. So, look, you'll get an absolute break with nothing to do. Can you imagine that? Meeting suspended. Reconvene with the governor and deputy governor of the Bank of Canada and start where we left off. We have time for 4 or 5 minute questions before we have to go to the parliamentary budget officer testimony. So we'll start with Mr. Polyev and then Ms. Rudd. Mr. Polyev, floor is yours.
Yes, it's normal for government leaders to make rosy predictions, and when they don't come true, to blame them on exterior factors out in faraway lands. I'm looking at your comments from the monetary policy update, Mr. Governor, and you attributed some of the downgrade to structural matter, which was global oil prices. And you compared oil prices to where they were 5 years ago. And of course, when you compare anything to a peak, you're going to be down. But it turns out oil prices are not low right now. Oil prices are actually quite high in historical standards. But if you convert them into Canadian dollars, they're almost average for the last roughly 35 years, 40 years. And from 1980 on, we had an incredible expansion of Canada's oil sector at those average inflation-adjusted prices. So what you didn't say in this remark, which astonished me, and I'm sure many others, is that it has nothing to do with global oil prices, which are high. It has to do with reaching the market. And I know it would have been politically inconvenient for the government if you had pointed out that market access and not global oil prices is the problem. But given that your job is not to help the government but to assess the facts, why did you attribute it to global oil prices rather than market access, which everyone agrees is the real problem?
Sir, are you referring to our monetary policy report?
Your statement, April 30th, that you presented.
My opening statement here this morning.
Yeah, it was the same one you did in your press conference roughly a few days ago.
Yeah, so there's quite a bit in our monetary policy report, not just this one, but in the previous one about those constraints, transportation constraints, market access constraints. Various terms are used. Quite a bit of analysis done by our staff on what the implications of that are. So today what I was drawing the distinction between is that yes, oil prices for today indeed are quite strong compared to where they were just 4 or 5 months ago. But what firms are telling us is that they're still planning to invest less. And the reason they're investing less is because of the uncertainty around market access. And that's what I was referring to in today's statement. So in the big oil decline in 2014-15, in the wake of that, we basically had about a 50% decline in investment intentions, which only makes sense because investment intentions were framed around much more expensive oil. But we now are monitoring another 20% decline in investment intentions this year based on the situation. It's not necessarily just about oil prices, but the situation, which I think is primarily about market access issues.
Right. No, just that I am looking at your statement, the statement from today, and it mimics the statement you made publicly, where you attributed, you said, continued adjustments in the, I'm going to read the whole sentence. Some of this downgrade is likely more structural than cyclical in nature, as it represents the continued adjustment of the sector to global oil prices of $50 to $60 per barrel.
Yeah.
I mean, again, I'm sure the industry would love to go back to the unusual peaks of 2013 and 2007, but those are anomalies. We're actually dealing with a fairly strong global oil price, and so it's not a global problem. It is a homemade one. Another comment you made, you're pointing, giving an explanation for the poor economic growth Canada experienced in 2018 and the low forecasts for 2019, even more dismal, was the U.S.-led trade war. Now, I'm against all trade wars. I am a proudly ideological supporter of free trade in all circumstances. But what I find interesting is that the United States is growing almost twice as fast as Canada, 2.9% in 2018. And China is growing 3.5 times as fast as Canada, 6.6% in 2018. So given that they are our two largest trading partners, that they constitute 80% of our trade, and that they are the principal participants in this so-called trade war, how can we possibly blame Canada's dismal growth on those two countries when their growth is significantly higher than ours?
Okay, well, just to close on the first question, if I may, what I'm suggesting in that line that you quoted to me is that I believe that the energy sector in Alberta continues to adjust to the previous decline in oil prices from the $100 range to the $50, $60 range. This is showing up in lower wage settlements, downward pressure on commercial real estate as well as residential real estate. Those adjustments by our models take 3 to 5 years to complete, and they're still in train. So that's just a reminder that we haven't fully adjusted to all that. So I'm not trying to argue that the current conditions don't matter. As for this, the U.S.-led trade war, the U.S.-led trade war is giving rise to downgrades and investment intentions in about 47 countries. That's not a coincidence that 47 countries have experienced the same slowdown at exactly the same time in the fourth quarter of 2018. And the mechanism that does this is business sentiment. That too can be verified through surveys of business sentiment. And so investment intentions have gone down across a wide swath of countries because of the uncertainty about the future of the global trading system. And that is the primary channel that we're monitoring in Canada as an effect. Going back to trade itself, it's a much more complex question. What effects are tariffs having? Direct effects. And our staff have done all the hard labor around that, and we estimate it's only taken about 0.4 percentage points off of global growth so far to the direct effect on trade. And of course, it's distorting trade. It's making some trade categories go up a lot, others go down a lot. And so it's really not possible to think of that as having that effect on 47 countries, because that's a jumble. But the one thing we have in common is weak investment, and I believe it's because of the uncertainty that the trade war raises.
Okay, thank you. We're a little over there, and that's fine. Ms. Rudd, and then who over here, guys?
Once again for joining us. I want to ask you to expand a little bit. Foreign direct investment rose to $51.3 billion last year, which was a 3-year high, the highest annual total since 2015. And the inflows of about $16.5 billion in the final 3 months, which is the second highest quarter that has happened since 2015. The bulk of the foreign direct investment last year was in non-energy sectors. So I guess as you talked earlier about the leveling off or stabilization of investment in particularly the oil sector, it appears that there is significant interest in investment outside that sector. Stats Canada stated that Canadian businesses are planning to increase by 2.5% in their investment, capital investments in 2019. Can you talk maybe a little bit about what the that means for growing areas of the economy, such as alternative sources of energy, the green economy, as we talk about electric vehicles, as we talk about the opportunities we have on the carbon reduced economy that Canada is very engaged in?
Sure. So the data you give us are correct. You know, despite a lot of concern about Canada's competitiveness and its ability to attract investment, 2018 there was about a 5% increase in inbound FDI, which was quite healthy. It's true that that increase was not in the energy sector. But that's, of course, I could say the same thing about domestic investment. So domestic investment was being pared here in Canada in that sector. And so the investment that we are seeing is in what we would call more growth sectors. That's not to say the energy sector won't attract investment, because it will, and it still is, but lower than it was before. And that its growth is perhaps constrained by transportation constraints, but SLAC makes more of an organic growth picture for the oil sector until there's a pipeline, let's say, in which case we might see then a jump in activity. But in other sectors, it's I would say that the biggest investment area is in intellectual property or softer forms of capital. So, and if we look at across the strongest export sector now is IT services in growth terms. The strongest labor market, the strongest employment gains are in IT services. And that's just for starters. This is the IT economy appears to be growing around 7 or 8% per year, attracting a lot of investment. And indeed, much of the investment is not even captured, because if you just buy services on the cloud, you don't have to invest. And so there's some big transformations happening. Makes it hard to read, but we do think that investment overall, according to our survey of 100 firms in the BOSS, everybody's ready to invest. So we're hopeful that the first quarter when we get those data, it shows it.
How much time do I have? A minute and a half. Thank you very much. Very interesting time, I guess, we're living in. One of the things you mentioned earlier in your presentation was around the impacts that provincial municipal sort of environments have on the housing market. And I was just having a conversation with my colleague before I came down, and I asked them if there's anything they'd like me to ask you. And they said, well, the Lower Mainland, Vancouver particularly, of course, in Toronto, and you mentioned it in your remarks, about the rest of the country responding to the measures that have been put in, and there being a couple of, being particularly Vancouver and Toronto, where there are challenges. Are those measures you mentioned from a provincial municipal perspective impacting, do you believe, some of those challenges in those two markets?
Well, the short answer is yes. So those measures, if you're talking about the stress tests and the tighter mortgage underwriting rules, they certainly had a countrywide effect, and that's because they were aimed at making the debt levels that were being taken on more sustainable for people that were taking them on, and then by virtue of that, a more stable Canadian economy. The extra measures that were taken in Toronto and the Greater Vancouver area with respect to taxes, for example, the foreign buyer tax, added to that, drag on the housing market. And in fact, Toronto and Vancouver were different to begin with, just because of price expectations being so speculative. You can see in some of the data that we have on price expectations just how high they were getting, and that those price expectations were reduced after the taxes, after B20, and then of course I think our interest rate increases had an implication for that too, and that's what's underlying the dynamic in the housing markets in those two jurisdictions.
Thank you. Thank you.
Turn to Mr. Kamish, and Mr. McLeod, you will round it out with the final questions. Mr. Kamish.
So thank you, Mr. Chair. Just in the monetary policy report, when it talks about, the economy hitting a soft patch, what assumptions are you making about the TMX pipeline construction project actually going ahead? And what would be the impact on the GDP forecasts here if there continues to be delays and more construction seasons are lost due to dithering? And then on the upside, if it does go ahead, is completed on time, what type of projections or how have you accounted for that project?
Yeah, so at this stage, I think we just have a question mark around the timing of that. So if it were to there would be some investment. Say, let's suppose that it were approved in the near term, there would be some additional investment spending this year, but the real impact on the economy would be after it's completed. I mean, there's of course the costs, the spending associated with its construction. So we also have in there. I know that Line 3, the other pipeline, is that is supposed to come in, I think, next year or later this year. Anyway, that's built in. So that would and of course gradual growth in the capacity to ship oil by rail. That is all built into the forecast. So the oil revenues and the oil exports that we've got are modeled based on those assumptions.
So in your monitoring report, you say the Line 3 is actually delayed till end of 2020, but you call rail the anticipated marginal mode.
Yes, right. So it's 2020 for Line 3, but yes, you get marginal increase in rail capacity as new cars become available.
Okay. Moving on to the FTHBI, so the first-time home buyers incentive, the shared equity mortgages. Do you think it will offset the effects of the B20 on the market, or do you think they'll exceed? Because those are all demand-side attempts to change the demand, people actually going and getting mortgages. So do you think it'll offset the impact of B20 stress tests on the market, or will it exceed in the future? Because your growth projections are that the housing market recovers in 2020, 2021.
Yeah. So the reason why the housing market recovers in that is, as I described in my opening statement, that when you have, in effect, B20 is reducing the potential on the margin, the potential demand for housing. People are reacting different ways, buying smaller houses or waiting a little longer to do it. But once they've adjusted to those new rules, then the fundamental growth from population growth and labor force growth continues. And so that recovery is in the trend line. So, but the question you're asking about the relative size of B20 effect macro versus this new first buyer program is very hard for us to know at this stage until we know the parameters of that program, as Ms. Wilkins answered a while ago. I think that the sketch around it was that it would be something like 100,000 households, that sort of thing. That's pretty significant, so we'll be figuring that in. But at the same time, B20 is affecting everybody, and so it's about how they adjust to that behavior. That's something that we're monitoring closely as we go through. So very hard to compare though. It's an apple and orange kind of analysis, I'm afraid. I wouldn't want to commit to a balance on those two.
Okay. So would it be fair to say then that the impact of the FTHBI is not included in your 2020-2021 projections?
That's correct. We don't know the parameters of it yet. One of the things that is implied there is it's designed to favor more housing building. Mm-hmm. And so that's a fairly significant piece of analysis to work out just how big that might be. But we have not included those things yet.
Okay, thank you all, Mr. McLeod.
Thank you, Mr. Chair. And thank you to the presenters for very interesting presentation and discussion today. As an MP, I certainly encourage people from all walks of life to come to the north, to visit us, to talk to the people that reside there. And I think over the last couple of years, we've seen good response. We've seen many MPs from all parties, ministers, all come to the north. And I saw that earlier this month, you were able to address an audience during the Nunavut Mining Symposium in Iqaluit. Mm-hmm. And last spring, you were in my riding and delivered a speech, which was also very glad to see. I wanted you to talk a little bit about the benefits of having the governor of the Bank of Canada coming to the north, coming and speaking and addressing the smaller and the northern communities, both for your work and for the local residents.
Well, thank you. Well, when I became governor, I committed to visiting all provinces and territories in Canada I can now say I've done so, which has been a great experience to talk to real people making real business decisions on a daily basis in completely different settings. And so I think the value to me is that it puts color around numbers. I mean, economics is just mostly a bunch of numbers, and being able to stress test forecasts or judgments with real conversations, I think, is very valuable. Always been valuable to us. We put much higher weight these days on both our boss and the interactive roundtables that we have when we're in a region. Both Carol and myself do that whenever we're out there. We'll organize a dinner or a lunch or something with, say, 12 or 15 business people. And so those things have been very valuable to us. And I think it also, there's two sides to it. We get to explain some things to people that, maybe they don't see every day, and we have those heart-to-hearts about, this is how we think the economy is working, and then they tell us, no, it isn't. This is what I see. So that's the kind of two-way conversations that we have.
In your speech in Nunavut and in the bank's latest monetary policy report was the advances of automation and artificial intelligence. Could you expand on your views regarding these, how these are advancements that are affecting Canada's economy and the potential risks and rewards as you see them?
Well, for sure, often these things are discussed in a frame of risk because you think of automation or AI, displacing jobs that are susceptible to that, jobs that are repetitive or and it goes from manufacturing type jobs to service type jobs, such as in the financial sector. I was on the phone with an AI yesterday, trying to get something sorted out, and it all got sorted out. But it's so that's phase one where what we hear about. But the other side of it is the jobs that are being created by those people that are creating those things and jobs that are maintaining those things. Like you put in an automated machine in a factory while somebody's making sure it's working properly and so on like this. And the third thing, which I think is helpful to bear in mind, is that each of those kind of major innovations in society generates incomes that we didn't have before. They kind of come out of thin air, and those incomes are spent everywhere in the economy. And so we create jobs in all the other nooks and crannies of the economy too. And that often is forgotten when people discuss these things. So in what we call the general equilibrium, history has shown that we always benefit from technological progress. It's never a negative. We always create more jobs than get displaced. Of course, it doesn't mean that there aren't hard adjustments for people. And so we need to always be cognizant of that and making sure that we have the right kinds of programs to help them transition.
Thank you.
Okay. We will have to end it there and move from one set of numbers to a second set of numbers, I guess, with the PBO. Thank you very much, Governor, Deputy Governor, and we will suspend for a couple of minutes for the Parliamentary Budget Officer and crew to come ahead. Shall reconvene pursuant to Standing Order 1082, a study of the economic and fiscal outlook with the Office of the Parliamentary Budget Officer. Welcome to Mr. Giroux, PBO, Mr. Mathieu, Senior Director, Economic and Fiscal Analysis, and Mr. Jacques, Senior Director, Costing and Budgetary Analysis. So I think one of you has an opening statement, and we'll go from there. So thank you for coming, and sorry for the little bit of a wait.
Monsieur le Président.
Good afternoon, Mr. Chair, Vice Chairs, members of the committee. Thank you for the invitation to appear before you today to discuss our April 2019 economic and fiscal outlook, which we published earlier this morning. As you know, the Parliamentary Budget Officer supports Parliament by providing independent and non-partisan economic and financial analysis to parliamentarians. As the legislation states, we provide this analysis for the purposes of raising the quality of parliamentary debate and promoting greater budget transparency and accountability. Consistent with the PBO's legislated mandate, my office produces an independent economic and fiscal outlook. As I said, Mr. Chairman, today with me are Jason Jakes and Chris Mathieu, who will answer your questions because they have a great deal of experience with the office.
Is working its way through a temporary slowdown. Economic growth slowed sharply in the fourth quarter of last year, following the decline in Canadian oil prices. We estimate that the real GDP growth remained subdued in the first quarter of this year, but expected to pick up over the remainder of the year as temporary factors dissipate. Looking further ahead, we continue to expect the economy to rely less on consumer spending and housing and more on business investment and exports. We project real GDP growth to increase from 1.6% in 2019, the current year, to 1.9% in 2020, and then to average 1.6% annually through 2023. We judge that the risks surrounding our economic outlook are broadly balanced. In terms of downside risks, we believe that the most important risk is weaker export performance due to rising protectionism in global trade policies. On the upside, the most important risk is stronger consumer spending fueled by increased household indebtedness. With respect to the fiscal outlook now, since our October 2018 outlook, we estimate that policy actions taken by the government will cost almost $10 billion per year, on average, over 2018-19 to 2023-24. Nonetheless, our updated outlook for the government's bottom line is, on balance, a little change compared to our October report. This reflects offsetting revisions to underlying revenues and expenses. In other words, we underestimated the amount of fiscal room in our economic outlook, mostly due to stronger than expected income tax revenues. For fiscal year 2018-19, we expect the budgetary deficit will be $15.7 billion, which amounts to 0.7% of the Canadian economy. We project the deficit to rise to $22.3 billion in 2020-21, due in part to foregone revenues from introducing accelerated capital expensing. The budget deficit is then projected to decline to $11.9 billion, or 0.4% of GDP in 2023-24. It's important to note this assumes no new policy actions are introduced. We also project that the federal debt will consequently decline to 30.5% of GDP in 2021, and which is almost 1.5 percentage points below the government's official debt anchor. We also project the federal debt to GDP ratio to fall to 28.9% of GDP in 2023-2024. Given the possible scenarios surrounding our economic outlook, and again, without further policy actions, it's very unlikely that the budget will be balanced or in a surplus position over the medium term. In our report today, we also highlight some key issues arising from Budget 2019 related to budget estimates alignment, operating expenses, and non-announced measures, among others. We'd be happy to explain these if you wish us to, and we can expand on that as well. J'aimerais également attirer votre attention sur un autre.
I would also like to draw your attention to another report we published this morning that provides PBO's independent costing of 11 policy measures from Budget 2019 that we have undertaken in preparation for my office's electoral platform costing mandate. The upcoming general election will be the first time in Canada that political parties will be able to request us to prepare independent cost estimates of campaign proposals. We have developed the capacity to manage costing requests equitably and securely while maintaining client confidentiality. We are ready for this historic opportunity, and we're looking forward to providing the best cost estimates possible. We would encourage all political parties and independent members to utilize our service. My colleagues and I would be pleased to respond to any questions you may have regarding our economic and fiscal outlook or other PBO analysis. Thank you.
Mr. Giroux, we'll start with the 7-minute round. Mr. Fregascott first up.
Thank you, Mr. Chair. Thank you for being here today. Mr. Giroux, you mentioned investment and exports in your opening statement as a source of real potential economic growth for Canada. Could you expand on that?
Yes. After the decline in business investments throughout 2017 and 2019, we expect that business investments will rebound, in good part due to the increase in oil prices in Canada and also abroad, but also due to the tax changes introduced in the fall economic statement, which both will be important contributing factors to increasing business investments. And the exports should be benefiting from sustained growth, albeit at somewhat lower levels in the U.S. going forward, as well as growth in Europe. So our main trading partners will continue to experience economic growth, which should help expand further our exports.
And where are we with attracting foreign direct investment?
It's an issue that we have not directly looked at as part of our economic and fiscal outlook. But maybe Chris and Jason want to expand a bit on that.
Sure. We've just been tracking. We don't, as Yves mentioned, we don't provide a forecast of that, but we have been tracking the data, the quarterly data that is published by Statistics Canada, and we did see throughout 2018. I would say probably an average performance. Initially, there were some concerns earlier on about the tax changes that were made in the U.S. and probably some investment being shifted out. But at least based on the data to date, I don't think we've really seen that materialize. So okay. It's roughly the investment levels are consistent with sort of the average investment over the past 4 years.
Thank you very much. Mr. Giroux, in your statement, you mentioned household indebtedness as a real source of potential risk in the Canadian economy. I wonder if you could speak more to that, but specifically from this perspective. We hear a lot of, well, certainly in the opposition, and there are some economists out there as well, that counsel that the stress test provides the wrong path for Canada, is not prudent economic policy. I wonder if you could put on the record your view of household indebtedness with the stress test in mind. We've heard from the Governor of the Bank of Canada, as you know, this morning, who in previous remarks has spoken about the need of a mortgage stress test in order to offset the risk to the Canadian economy in terms of creating a housing bubble.
Sure. So, with respect to household indebtedness, it's clear that one of the main factors is the relatively low level of interest rates, which, of course, encourages people to take on more debt. Another big factor contributing to high levels of debt is the relatively high price of housing. So, when household formation happens, people want to live somewhere, obviously, and they either have a choice to rent or to own. And owning means buying a house, incurring some mortgage debt. And when the prices are high and interest rates are low, that leads to high indebtedness. So it's not in and of itself an issue, but it is a concern as an economist when we see that households have high levels of debt. And it's obvious that it's not sustainable in the optics of rising interest rates. It's bound to lead to some imbalances in the economy. With respect to whether it is the right action to limit the growth in credit and have tighter mortgage rules, that's a question that's very delicate. I think it's obvious that something needs to be done. However, with high prices of housing, it means that some people will be denied access to housing. So something needs to be done, obviously, to rein in the high levels of debt, but it has the unfortunate collateral effect of preventing some people from accessing to property, especially in high-priced markets of Vancouver and Toronto, and now more and more Montreal.
You're right. It is delicate because it's something that's come under debate. But as you say, something needs to be done. And Mr. Poulos is obviously gone, Mr. Chair. But I'll just read into the record comments he made a few months ago relating to household risk. So this is Mr. Poulos saying the following. The biggest risk we face in the financial system is that household debt is not able to cope with a more normal level of interest rates. If people can afford a mortgage today but can't afford it 100 basis points from now, then we're not doing them any favors. So thank you. I know you didn't want to get into the stress test side of things, but you did say that something needs to be done. I will tell you that the economists that I read and the economists that most Canadians, I think, look to provide an analysis of where we are, have worried in the past about the potential for a housing bubble and where household debt is. So I think something like a mortgage stress test is a prudent move. The debt to GDP ratio, which you talked about, where does that compare? Where does Canada compare to other industrialized countries in that regard?
When we look only at the federal debt to GDP ratio, it's quite low compared to international partners. However, if you want to compare things that are comparable, for example, the UK is a unitary state, so if you look only at the federal level, we look obviously advantaged. So a better gauge of debt levels to GDP take into consideration both the federal and provincial and territorial debt levels. And by that measure, I haven't looked at the numbers recently, but I think we're slightly below the OECD average or close to the OECD average. I think we're slightly below. So we're faring very well. Where we have a better advantage is when you take into consideration pension obligations. As you know, Canada has a three-pillar system when it comes to the retirement income system. There's public systems, OAS, private savings, as well as the public pensions, CPP and QPP. And Canada is in the unusual situation of having pre-funded a good proportion of its future obligations when it comes to the QPP and CPP. So if we compare that with the pension obligations of most other major countries, we are in a better financial position when you take all these into considerations for the debt to GDP ratio.
Thank you. And there, Mr. Richards, the floor is yours.
Thank you very much. Got a number of topics I want to try and, I guess, ask you about. We'll see how hopefully we can get to them all. First one is actually just relates to your February 21st report. And it was, you talked about, well, I'll just read, actually quote from it. PBO found the Pension Act regime that was in place from 2006 to April 1st of this year is the most generous for the veterans. From the perspective of the veteran, virtually all clients would be better off if they were to receive the benefits of the Pension Act. Or, if you put a different way, that means that veterans will now be worse off almost across the board under the new regime. Could you maybe just expand a little bit on your findings there and just tell us exactly how much worse off you think veterans will be under that new regime?
Sure. What we found was, well, we looked at the three main regimes, the ones that were in place up until April 1st, 2006, the regime that was in place between 2006 and the end of March this year, as well as the regime that will be in place starting or since April 1st, 2019, so a couple of weeks ago. And you'll have to forgive me, I forget the names of each of the regimes because, as I said on a few occasions, these are very complex regimes. I have a background in tax, and I find that, to be honest, more complicated than the Income Tax Act. So that's one of my failings. I guess I don't understand very well veterans programs. But what we found was that the regime that was in place pre-2006 was the most generous for the vast majority, if not the totality, of veterans. And the regime that has been in place since April 1st is slightly more generous than what was in place between 2006 and 2019, but it also left out some of the veterans. So especially it's more generous than the regime that was in place 2006 to 2019, but it also does not provide the same level of benefits, to a few veterans. I think it's 5% of the veterans, and these tend to be the most highly disabled. So these are the main conclusions of the report, if I'm not mistaken. So Jason is nodding, which means I haven't made any mistakes in characterizing the report.
And you're nodding, yeah. Okay, all right. Let's touch on the report, the April 30th report, not today's report. You indicated this quote from it again for 28, and I think you mentioned this in your opening remarks as well. 2018-19, we expect the budgetary balance will show a deficit of 15.7 billion, and then you go on to say we project the budgetary deficit to increase to 22.3 billion in 2020-21. And then you also further on estimate, we estimate that the probability the budget will be in balance or in a surplus position in 2019-20 and 2020-21 is effectively nil. So just to be clear, in the year and the years following the year that Justin Trudeau said he would balance the budget, he's actually going to be increasing the deficit. Is that correct?
That's the conclusions at which we arrived. We see no possibility of balancing the budget in 2019-2020. And in fact, we see the deficit increasing to 22.3 billion by 2020-2021, which is a combination of policy actions that are significant, which more than offset economic and fiscal developments, positive developments. So we see a significant increase in our forecast for the deficit. However, this deficit is expected to decrease over the planning horizon, decreasing to 11.9 billion by 2023 and 2024. We've also made a long-range forecast or projections, and in our forecasts or projections, we expect the deficit to return to balance in the absence of any further policy actions in 2028-29.
Okay, so about 10 years after it was promised to be.
Yes.
Okay. So let's move from deficit to debt. What's your numbers for where the current federal debt stands?
Well, we have as a proportion of GDP, which is a useful measure because it puts it into
But
perspective.
what I'm interested in is the number.
The absolute level of debt. So we forecast federal debt at $687 billion
Almost 700
in
billion.
in the previous fiscal year, so 2018-19, and rising to $766 billion by 2023-24.
Okay. How much interest? What's the current interest payments on that debt?
Well, in 2018-19, we believe that they were at 23.4 billion. That's our estimation.
Okay.
Final numbers are not in yet, and rising to almost $34 billion by the end of the forecast period, which is 2023-24.
Okay. What percentage of government spending is actually going towards servicing the debt?
Of government spending, I have to do some mental math, which is always tricky. But Chris is much better than me. So as a percentage of GDP, it's 1.1%, rising to 1.3%. But as a percentage of government expenditures, I don't.
Less than 10%, maybe 6 or 7%, I would think.
Go ahead.
Oh, sorry.
Go ahead, Chris.
As Yves said, I'm not very good with on the fly simple arithmetic, but it looks to be below 10%, probably. I would guess around 7% of total expenses.
Okay, last question, Mr. Richards.
Sure. Now, in the mandate letter the Prime Minister gave to the Minister of Finance, he identified meeting the government's fiscal anchors as one of the top priorities, saying that ensure that our fiscal plan is sustainable by meeting our fiscal anchors of balancing the budget in 2019-20 and continue to reduce the federal debt to GDP ratio throughout our mandate. You indicate, though, that the government has been inconsistent in its reporting on progress towards meeting those two fiscal anchors in budgets and in their fall economic statements. It sounds like what you're saying is that the government is moving the goalposts on how they judge their fiscal management. If so, can you explain how the Liberal government has in fact done that?
We flagged that in our report by raising a couple of issues of interest for parliamentarians. And one of them is the government's progress in meeting its fiscal anchors. As you pointed out, one of the fiscal anchors the government had was balancing the budget by 2019-2020. It never, to my knowledge at least, it never has explicitly abandoned that fiscal anchor. And as you pointed out in the mandate letter by the Prime Minister to the Minister of Finance, there was a commitment to balance the budget in 2019-20.
So sorry, you're saying it hasn't abandoned that. So there's
Officially,
some possibility that could occur.
Officially, not to my knowledge,
okay.
or explicitly. In fact, the website that tracks mandate letter commitments still shows that commitment as actions taken, progress made, but facing challenges. So
yeah, it sounds like it. Yeah.
So challenges, yes, but it's obvious that that fiscal anchor has been abandoned. There's no doubt about that. So in our report, we suggest that maybe the government wants to be more explicit about that and focus instead on the federal debt to GDP.
Put it differently, could be more honest about it. Is what you're saying.
And I think did you not ask for the debt to GDP ratios as well? No. Okay. You don't want those stated, I guess. Mr. Dussault. And then over to Mr. McLeod.
Merci, M. le Président. Merci à vous.
Thank you. Thank you, Chair, and thank you to the PBO as well. My first question is this. In your reflections, there was a paragraph on unannounced measures. Perhaps you could go over that. I'm going to give you the opportunity to speak to that. What do you think that represents in terms of the reform and projecting budget projections, estimates, and also what effect that will have on the transparency of certain expenditures, which are not explained, but which are being asked of parliamentarians to vote upon. Well, first of all, what feeds the budget and the estimates, of course, is the business of supply. I think there is ample transparency in that area. In the presentation, there was a specific credit for a vote that dealt with appropriations for parliamentarians. This year, the Secretary of the Treasury Board has presented it in a different way. That is certain measures, but it is on a department-by-department basis. And the business of supply, it relates to the business of supply that you are called upon to vote upon. And I think that's an improvement. There was some criticism that was addressed, that arose and was addressed by the government as to the whole process of supply before Treasury Board carried out its very careful examination. And there could even be changes after the parliamentarians vote upon the estimates. It's a criticism that remains. It's a valid one, but as to whether or not it affects the very nature of supply, no. There is another improvement that has been made with respect to the transparency that was requested in terms of what existed in the past. There were some unannounced items, but sometimes it is a negative item. For example, in a previous budget, there was an item of $3.8 billion. So it indicates either there was a drop in expenditures that were left unspent, or there was an increase in taxes and tariffs. Does this represent provisions that were made, that were budgeted for, but were not used, were not needed? So there's quite a wide array of possibilities. But there was uncertainty in the past that wasn't mentioned. Now we mention that here. There is a whole amount, quite a large array of unannounced expenditures that are being stated more transparently. Yes, it is quite a lot. My other question is this. You know, in the past, you alluded to what should have been done in terms of program expenditures by the government, that there was not a foreseeable growth, that it didn't relate to the normal rate of growth of program expenditures. It seemed to remain stable. What percentage was not significant last year? This is always something that is noted when we look at it. Has it been corrected? In terms of expenditures, it can amount to quite a substantial amount between 2018 and 19, $308 to $371 million. So these are not negligible amounts. What can you say about the process? We speak about the budget tax that differentiates between departmental spending, 3% per year increase, but also the increase in terms of retirement and social benefits for the public servants. There has been a drop. We have had to base our amounts on the figures provided by the government, but they aren't disaggregated. Based on that, we were able, though, to derive a 3% increase. Is this sufficient or insufficient? That, in essence, is a political matter. But I could say, as an editorial comment, that this 3% figure for operating expenditures does not correspond to the past history of previous years, where projections do not take into account new policies. But of course, every year we can reasonably expect that the government will have new policy, that there will be growth in that area. Okay. Another question that I wanted to ask of the Bank of Canada, but I will ask it to you. The difference that we see in the GDP growth, it's quite substantive when we look at it. If you look at a growth for 2019 of 1.2%, and the private sector, the economists in that private sector used by the government in its 2019 budget quoted 1.8%. So that's quite a big difference over a year. 0.6%. Did you use 0.6%? Yes. Can you explain to us then the way that we can be faced with such different figures? Given that there are general figures related to the economy? Well, it depends on the relative weighting that is attributed to a variety of factors. For example, I can't speak to a private sector economist or the Bank of Canada and their reasoning. But when we look at business investment, we think that there's been some difficulties in the last part of 2019, energy, but we think that there will be an economic recovery towards the end of 2019. The economy should remain quite stable until that time. There is a certain amount of vigor in the economy, and perhaps that contributes to the fact that we are being more optimistic in our projections than others have been. But nonetheless, there are issues in terms of international trade that perhaps are not as optimistic.
To Mr. McLeod, and then back to Mr. Polyev. Mr. McLeod.
Thank you, Mr. Chair, and thank you to the witnesses for presenting here today. I wanted to touch on a report that was put together by your office, I think, in the middle of April, on the infrastructure investments in the territories. The report was critical of infrastructure spending in the north, and I found it odd that in spite of many, many announcements and roads and highways and airports and housing, that the report came out in the fashion that it did. So it raised a lot of questions. So I guess my question would be, if can you verify that your report was looking solely at the Investing in Canada plan and not at the broader scope of infrastructure? And I raise this because without including measures such as the Trade and Transportation Corridors Fund, the investments in housing, the investments in broadband, disaster mitigation, and everything else, it really doesn't paint the bigger picture when it comes to infrastructure investments.
Well, we wanted to look at the impact of the Invest in Canada plan, so we focused mostly on this. But with respect to the specifics, I think Jason would be in a better position to answer about your question.
Sure. I think with respect to the specific elements that we looked at, it contained the entire envelope of federal spending, so the roughly $180 billion, which of course, to your point, includes the broadband's, of course, part of that overall envelope. And I think to the extent to which you mentioned that there are significant investments occurring, one of the key findings of our report, both in the case of the territories and the provinces, is the fact that there is money being spent and there is new infrastructure being built. It was more focused on the question of, is it actually incremental in nature? And based upon our analysis, we
like the preliminary data seems to clearly indicate that incrementality is not being met.
The report generated a lot of discussion, and many people have pointed to the fact that this is more of an accounting exercise. But they also pointed to the fact that the report and the exercise lags quite a bit behind in actual activity, and sometimes it's often behind in years until all the bills are paid. So it makes me question the logic of the report. It only focused on one piece. It didn't look at the big picture. So why the report? Why not do a comprehensive report rather than just one section of investment, one program, only the Investing in Canada plan, when there's many other investments being made? And if this is supposed to be our benefit, I don't see it.
The report, as Jason mentioned, the aim of the report was to look at whether there was indeed incrementality as a result of the federal investments, which was one of the main goals of the federal government's programs when they were launched, when they were announced in 2016. Incrementality at that point was an important aspect with the view of stimulating economic growth and creating jobs. So we knew we had a good idea about the numbers, the federal numbers. So the intent of the report was to look at whether the federal investments had really triggered incremental spending by provinces and territories, or whether there was some displacement, because we had heard that anecdotally, and we had heard that also from parliamentarians, that they were not convinced there was full incrementality, quoting very valid reasons. For example, some provinces and territories were cash-strapped. There was, in some regions, believed to be a lack of a sufficient number of projects that were ready. So we looked at that, and we looked in aggregate at expenditure plans of provinces and territories when they were available. But it's for sure the data is not perfect, and our reports, it's valid for that report as well as for any other report. Our reports can only be as good as the quality of the data we're provided.
Yeah, well, I'm hoping at some point we're going to see a comprehensive report with all the different investments included. My final question is a question in this document here regarding one of the projections you have in the economic and fiscal outlook on table 1. You have listed that the contribution of exports to real GDP growth at 1.2% in 2020, and then it drops down to 0.6% in 2021. I'm just curious why. Maybe you could explain to us what the cause of this projected decrease.
Sure. Thanks. Yes, those are the contributions to real GDP growth from the export sector. So their actual export volumes are growing faster than that, but that's the actual impact on the headline real GDP growth numbers. But you're correct that we do have a fairly solid growth up until 2020, and then the decline after that. That's more of the moderation in the U.S. economy that we see. So we had U.S. growth of around 2.5% per year. We also have sort of the world economy more broadly returning back to growth in 2020, rebounding. And then for the U.S. economy, there's that moderation after that.
Thank you all. Then turning to Mr. Polyev, and then back to Ms. Rudd will be after Pierre.
You find that the government has almost $4 billion of unannounced spending and no way identified to pay for it. Is that an accurate characterization?
You mean in the unannounced measures?
Yes.
That's not what we find. In fact, what we find is that in aggregate, there could be $4 billion of unannounced measures, but it translates into a net minus 3.8. So a net either reduction in expenditures, increases in taxes, or a combination of both. So if in your scenario, the example you mentioned, $4 billion of unannounced expenditures would probably mean $7.8 billion of other offsetting reductions or tax increases for a net of minus 3.8. So that's what we find. The government mentioned in its budget unannounced measures for a net minus 3.8. We've asked finance officials, and were not provided with concrete explanations. Budget secrecy or decisions still to be made, whatever the reasons, valid or not. But we interpret that as expenditure reductions or tax increases or a combination of both for the forecast period totaling a net $3.8 billion.
So what is an unannounced measure?
It could be anything that the government has not yet announced. It could be a tax increase. It could be expenditure reduction of any sort. It can be virtually anything.
And why would a government conclude an unannounced measure like that?
Well, it's quite common when the government has valid reasons to believe that they will indeed announce that. They've either made a decision already or there's a certain level of certainty with respect to action the government will make, but is not ready to announce it. It could be commercial confidentiality reasons. It could be strategic reasons.
But in other words, when you say $3.8 billion, that means that for the overall fiscal framework to go ahead as foreshadowed, they would have to find either $3.8 billion in new revenue or $3.88 billion in spending cuts or some combination thereof.
Yes, and the fact that it was an unannounced measure in the budget suggests that it's more advanced than they will have to find. It suggests that.
And in what years will they have to find it? Just quickly, we're running out of time.
It's laid out on page 30 of the English version.
I'll take a look at that. Can you also provide us with the direct program spending of the government in years 2015, 16, 16, 17, 17, 18, 18, 19, 19, 20, and all the way through to 20, 25, 26?
We can certainly provide that.
Thank you. On infrastructure, did you indicate, you, Mr. Jacques, indicate that you did not find incrementality. So in layman's terms, that what you're telling us is that the government's infrastructure programs didn't actually deliver additional infrastructure that would not have otherwise occurred. Is that an accurate description of incrementality?
That's an accurate description. I think the key findings in our report is that you do see a bit of a boost, but the boost that the government said that we were going to get out of it, so in terms of the matching of 1 to 3, in terms of $1 federal spending and $3 being matched by other levels of government, that's certainly not borne out by the data. And again, that's something that when you look at the empirical research, that's borne out in other jurisdictions.
Government includes a bunch of spending under its infrastructure envelope that doesn't actually necessitate additional construction of anything. For example, transfers to the provinces for so-called child care programs could pay staff members at a provincial level, even staff members who don't necessarily provide child care. But it doesn't necessitate that new child care facilities will actually be built. Do you have any evidence with regards to how much of the so-called $180 billion the government has committed to infrastructure will actually go to the construction of new assets that would not otherwise have been built?
I don't think we have that level of granularity because there are thousands of projects in Infrastructure Canada's database, and we have not gone through each and every one of them and made that judgment call.
You have it. Can I just conclude with what? Do you have a different definition
Pierre,
of infrastructure from the government?
Miss Rudd.
Thank you very much, Mr. Chair, and thank you for coming and presenting to us today. There are a couple of things a couple of questions in your remarks, and something I'd like to clarify. If you just give me 1 second here. when we were talking about the money for veterans, and I found your summary table in your report. So thank you very much. I'm a numbers person, so I appreciate the clarity of numbers. So just for the record, based on the former program that was in the last government, the present clients would receive $22 billion. Under the Pension for Life scenario that's coming in 2019, those same present clients will receive $25 billion, so an increase of $3 billion. New entrants would receive the same as they did in the former plan to this plan. So a net increase of $3 billion, just for the record. I know you were struggling there about the 5% and what have you, so I thought that might be helpful. The other thing in your fiscal outlook, in your remarks today, you had said, and I'm going to quote, "We project that federal debt will decline by 30.5% of GDP in 2021, which is almost 1.5 percentage points below the government's official debt anchor. We project the federal debt to GDP ratio to fall to 2.8 or 28.9% of GDP in 2023-24. Could you explain to people who might be watching or interested in hearing this what a debt anchor is?
Well, a debt anchor can be defined in a few ways. It could be the absolute level of debt, or it could be the debt in proportion to the size of the economy. And the government has chosen to opt for the second version, the debt as a proportion of the economy, federal debt as a proportion of the economy. And the government's stated goal is 31.9% of GDP, the debt to stand at 31.9% of GDP. So one can reach that by adjusting the level of debt, its deficits, cumulated deficits, and it can also stimulate or slow down in the very unlikely event, or stimulate the economy because it's a denominator and a numerator. So the debt divided by GDP. Of course, if the GDP grows faster, you don't need to do that much with the debt, and the debt represents a smaller share of the economy. And that's the type of anchor the government has chosen.
Thank you very much. We talk about debt to GDP, and I think often it's sort of people's eyes glaze over, and they're not necessarily...
I don't understand that type of reaction being an economist, but yes,
sure
apparently it happens.
You also mentioned something about the 3 pillars of our pension system, and the fact that that has positioned us in a very good place as a country compared to others. And you talked about the Canada Pension Plan, the OAS, and the private plans. And as we know, there's been a shift in the past number of years away from defined benefit plans and even defined contribution plans to more of a self-contributing RSPs, TFSAs, and all of that. So one of the things our government did was increase contributions to the Canada Pension Plan with a long-term view of increasing the income that future recipients would have. And did you include that in sort of your projections around this plan and in terms of the numbers that you were talking about the strength of this program?
Yes, these types of government policies that have been announced and implemented are included in our forecasts.
Okay, thank you. And if I have time for one minute, quick. In your labor market prospects, you talk about the decline largely, we're talking about employment rate. The decline largely reflects demographic factors as an increasing number of baby boomers, I am one of those, leave the labor force. However, employment levels will continue to increase over this period, given solid population growth averaging 1.2% annually. In that number, is immigration factored in that number?
Yes, we have factored in immigration levels, and our demographic assumptions are based on those from StatsCan. So I don't have the numbers off the top of my head, of course, but yes, they are included.
Okay, thank you very much.
Okay, then we'll turn to Mr. Poilievre and then Mr. Fergus.
Do you have a different definition of infrastructure than the government?
I'll go. We have taken, when we do our reports on infrastructure programs, we have used the government's definition of infrastructure because of the nature of the program, the number of infrastructure projects. So we have not decided what should be counted as infrastructure and what should not be as classified as infrastructure, because the objective of our report was to determine whether there was incrementality in provincial spending or not. That being said, there are various definitions of infrastructure, and I have to say, when I glanced at some of the projects, some didn't strike me as infrastructure in the sense that I had expected. For example, I saw communications equipments for public transit systems, bus shelters. So these are a couple of examples that I remember that struck me as, at the very least, light infrastructure projects. So to answer your question, we have used the government's definition of infrastructure.
You comment on the lack of incrementality in the infrastructure programs. Can you give us examples of the type of infrastructure, so-called infrastructure spending, that has displaced other provincial and local spending which would otherwise have occurred?
We don't have specific examples because we looked at macro level. So, and what that means, we looked at provincial and territorial investment plans when they were available, as well as municipal plans, pre-announcement and post-announcement. And in the presence of incrementality, the pre-federal announcement plans should have been augmented or bona fide to take advantage of the federal plans. So it means that before the government announcing its plan, there were projected levels of investment by provinces and territories. So when the government announced an increase in its infrastructure programs, we expected to see an increase, corresponding increase to provincial plans, which did not materialize to the same extent. So there was some level of displacement, but we didn't do the micro analysis looking at project by project, because I would have needed much more analysis and much more analysts than the number we have.
So as federal spending on so-called infrastructure has increased dramatically over the last 25 to 30 years in Canada, we've also seen a very dramatic increase in the personnel budgets of the municipalities. And one would say, well, what does one have to do with the other? Well, what it clear to me is happening is that federal spending is displacing spending that would otherwise have happened. And then municipalities are taking the freed up money and using it to expand their personnel. Does that sound like a realistic hypothesis to you?
That sounds like something very plausible that has probably happened, at least in part. To say that it has entirely displaced provincial and municipal spending, or the opposite, is probably too strong, but it's happened at least in part, based on what we found.
And how do your estimated impact, growth impact of the government's new infrastructure spending, how does it compare to the government's promised impact?
I don't remember off the top of my head. Maybe Jason has a better memory than me because he's younger, but maybe not.
It's in terms of what the government actually originally tabled as part of Budget 2016 versus our most recent report around the economic impacts, we're roughly at about half. But that half is primarily attributable to the fact that there were delays in actually getting the program out the door. So initial delays in actually negotiating the agreement with the provinces and the municipalities, and then further delays in actually cutting the checks to actually get the projects approved. So all that said, at some point in the future, with those delays, the government still indicated that the money's on the table, so potentially there's going to be some pickup or recapture at some point in the future.
And when the government spends borrowed money, that money has to be borrowed out of the economy. what do you take that into consideration when you determine the impacts on economic growth of infrastructure and other governmental spending?
No, we don't take that into account when we look specifically at the infrastructure programs. We take that into account when we do our macroeconomic projections, but when we look specifically at infrastructure programs, we don't take that into account because that would require second and third order impacts, and it would require dynamically estimating the impacts of these programs, which would be significantly more complex.
Turn to Ms. Rudd and then back to Mr. Dessau.
Thank you. And I just want to maybe if you can provide some clarification, because I think we've sort of been skirting around this in a number of ways. Mr. McLeod talked about the infrastructure in the north, and you talked about the lack of incremental progress. As I'm understanding it from your report, is that the programs by which the federal government puts infrastructure money out is supported by provincial municipal governments as partners, usually a third, but there are variations on that theme. And my understanding is further that in provinces, as an example, Ontario, where the provincial government has not released their infrastructure programs, that the federal money is not being leveraged to the degree it could be, and indeed should be, in order to realize those incremental increases in infrastructure growth. Is that fair?
What I'd say is that we have not seen any instances where, or we have not been made aware of any instances where provinces, territories, municipalities did not cough up their share of the program funding that they were supposed to provide under the agreements. What we have seen at the aggregate impact is that some provinces and and territories have displaced a portion of the funding that in order for them to meet the matching requirements. So they have limited financial capacity, and they were not either able or willing to fully provide a totally incremental funding for the infrastructure program. So our suspicion, we have not looked at specific programs, but looking at the aggregate numbers is that some provinces and territories did slow down some other projects that were not subjected to the cost sharing with the federal government.
Mm-hmm. So I'll go back to the example of Ontario. Yes. There are 4 streams of infrastructure, and there is an agreement between Ontario and the federal government. It's been in place for almost 2 years now. And recently, the roads and bridges stream was opened for about a 4 or 5 week application process. But there has been no opening of the streams for water, wastewater, rural broadband and cell, or housing. And so what we're finding are challenges within municipalities who are ready to contribute and be partners. But because the provincial government has not sort of stepped up to the plate and honored the agreement, things are being slowed down. And I guess my question to you, do you have any sense of what Ontario's very large province, what that would do to the results you're talking about if in fact that were to be realized as per the agreement?
Well, that would obviously slow down the pace of implementation for that stream of the program. And these are questions that Infrastructure Canada officials would be in a very good position to answer, and they'd be able to provide you with specific examples, I'm sure.
Thank you. Peter?
Is there time for a question?
And we will be coming back a little while later anyway, so you got lots. Go ahead.
I just wanted to ask a question. We hear from the Conservative opposition and Conservative provincial governments, not exclusively, but many provincial leaders who carry the Conservative banner have joined with their federal colleagues to say that there is economic ruin that will result from putting a price on pollution, and in carbon pollution in particular. Is there evidence from other jurisdictions that putting in place a price on pollution results in economic devastation? You're an economist and an expert, and very neutral.
These are very harsh words, so I will not venture into these types of adjectives, but we looked at the impacts of putting a price on carbon in Canada, the economic impact, and what we found was a 0.1% impact on GDP, negative impact on GDP per year. So it's a level difference, so 0.1% difference. And if Chris is not kicking me, it's probably because I have he wants to kick me. So we found a small negative impact on the level of GDP, which is probably not 0.1%, contrary to what I'm saying.
Just to clarify, it is an impact of 0.1, but it's a percentage point on real GDP growth per year. So over a 5-year period, at the end, the level of real GDP would be 0.5% lower, and that's considering a scenario with let's say the federal plan in place versus a scenario without any carbon pricing in the economy.
And Canadians get rebates to offset increased costs, yes?
In the provinces where the federal backstop is in place.
Thank you.
Go to Mr. Dussault, and then if anybody's got a question over here, and we'll probably conclude at that. Mr. Dussault.
Oui, merci. Puis c'était juste peut-être pour revenir à...
Thank you. Coming back to a question I had on spending. Page 48 of your report. As a percentage of GDP in the program exchange seems to be dropping as a percentage of GDP, dropped from 14.6 in 2019 to 12 or so percent in 2023. Is that standard, or is it a matter for concern? I wouldn't say it's a matter for concern, but it's not standard. As I said in my opening remark, the figures I gave are projected on the basis of there being no new public policies that change things radically. We're looking at the changes, economic changes over the long term that are predictable, like demographic change, our projections on energy prices, world macroeconomics, etc. Those are taken into account. Public policies that are currently in place or have been announced with some certainty. That's what gives us the figures before you. But that said, not many governments are elected and then make no changes to the government programs they find. So is it plausible to believe that government programs will remain as they are? Probably not, because successive governments do change existing programs or amend existing programs. Something we would expect would be governments spending to remain stable as a percentage of GDP. That's fairly common. But that said, a government might want a greater government presence in the economy, more intervention, or the opposite, a smaller role by the government in the economy. That can be achieved through direct spending, a number of mechanisms, or transfer payments that go up or down. So if we look at program spending on its own, that tends to give us a somewhat skewed picture of government spending. Thank you. My last question, unfortunately, is on the scenario of having interest rates go up by 100 basis points. Wouldn't that have a significant impact? That's on page 54. $3 billion in 2019, 7.6 billion in 23-24. In your projections of the prime lending rate of the Bank of Canada, you are expecting it to go up by 1% by next year. That's quite significant, and many people might have some fears about the impact this would have, particularly those who hold mortgages, since household debt is very high. And many Canadians are close to the threshold of not being able to manage. So how can we establish what the risk to the economy would be of interest rates rising by 1%? Not only the danger or the risk to the economy because of the public debt, but also to Canadians more generally. The Bank of Canada rate is not that significant an increase, historically speaking. We have already had rates as high as 18-20%. So an increase of the daily rate from 1.75 to 2.75, that may be a large increase in absolute terms because they're so low, but these are not rates that would be that high. This would actually take the rate up to something neutral. Monetary policy would be neither driving the economy or stimulating the economy, nor would it be slowing it down. So 2.75 would have a neutral impact in combination with the monetary policy in place. So no stimulation, but no brake on the economy either. It would have a not insignificant impact on households, but it would not be unduly devastating.
Well, further questions? Just one to close off. In your executive summary on your report on the expenditure plan and main estimates, you do mention that elderly benefits are the largest major transfers to persons, and you also mention the increases in the gas tax fund and Canada Health transfer account are the two most significant increases in major transfers to other levels of government. Do you have the bottom line in terms of you outline what the $2.2 billion increase in the gas tax fund, which is doubling it, and the $1.8 billion increase in the Canada Health transfer? What's the bottom line there? What is the total amount of expenditures in those two categories?
Do you have that?
I don't. I think that's the estimates. Jason.
One of the problems that even in our budget documents is we often talk about the increased percentage or the increased amount, but the bottom line figure is you got to search here and there to find the bottom line figure. I find that a problem. So if you could give us the bottom line figure for what the gas, well, I guess the gas tax fund now would be, if it's doubling 100%, it'd be 4.4. Mm-hmm. What is it for the Canada Health transfer?
Go ahead.
Which is a question we get a lot.
Yeah, it's going up by $1.8 billion in cash terms.
Pardon?
$1.8 billion.
Yes, I know that's what it's going up, but what's the bottom line? How much is the total transfer annually on the Canada Health transfer from the federal government to the provinces?
$40.4 billion, Mr. Chair.
$40.4 billion. And do you have before you what the transfer is to persons in terms of elderly benefits? You got that there as well? It's increasing, I know, 2.5, but
it's $56.2 billion.
$56.2 billion. Okay. With that, are we all in, all done? Okay. Thank you very much, gentlemen, for your presentation and answering our questions. Unusual for us to be done a wee bit ahead of time, but we'll take it. Thank you very much again, and meeting adjourned. We'll see you again all at 3:30.